Hello and welcome to this session in which we will discuss substantive analytical procedure when it comes to inventory. Now what we did for every cycle, we perform analytical procedures, substantive analytical procedures. And at the beginning of every cycle, I briefly discuss what are analytical procedures and when are they used. I know I repeat myself, but repetition is important. It's beneficial. It's going to help you remember the benefit and the meaning of analytical procedures, which is what? Studying the relationship between various numbers. Why? Because relationship might reveal unusual patterns. For example, if our debt goes up, our interest costs should go up. Well, there should be a relationship between the two. Let's examine this relationship. What are some tools in our analytical procedures toolbox? Ratios, all sorts of ratios, X over Y, horizontal analysis, looking at things across time, vertical analysis, looking at things in relationship of a total. The main goal is to spot any unusual fluctuation that we need a closer look. For example, when we look at sales, are sales higher than what we expect them to be? Or is cost higher than what it should be? Is our inventory gathering dust in the warehouse? How do we know this? Inventory analytical procedures. Certain figures would let us know if, for example, the inventory is sitting for too long. Gathering dust means the inventory is sitting for too long. Well, if we find out it's sitting for too long, we need to ask ourselves, why? Why? Let's review one more time. When are they used? They are used in three different stages, or they could be used in three different stages. In the first stage, analytical procedures is a requirement. At the beginning of the audit, this is required as part of risk assessment. During the audit, you have to use your judgment to decide whether to use analytical procedures or not. This step is optional. At the end of the audit, they provide a final check to ensure everything makes sense. This is required. And in the real world, this step is carried by senior manager or a partner, someone who really understands the business. Remember, the reliability of these procedures, analytical procedures, depend on the consistency of the numbers. So, if the numbers are all over the place, they fluctuate, it's a seasonal business, it's tough to draw meaningful conclusion. Now, we could make certain adjustment, but it gets a little bit more challenging. For example, for cycles like property, plant and equipment, and payroll, we found out that analytical procedures are very useful. Now, keep in mind, they are useful in every single cycle. Don't get me wrong. I'm just saying they are useful in certain cycles more than others. So in this session, we're going to dive into, you guessed it, analytical procedures for inventory. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. The first one we're going to look at is gross margin percentage or gross profit margin percentage. We compare this from year to year as a good starting point, because what goes into gross profit margin? Sales minus cost of goods sold. Sales minus cost of goods sold would give us gross margin or gross profit. Cost of goods sold is the inventory that was sold. So we want to know, what is the relationship between sales and cost of goods sold? For example, let's assume year one, where the prior year gross profit was 60 million and sales is 100 million. If we take gross profit or gross margin, let's say gross profit or gross margin, we're using them interchangeably here. If it's 60 million divided by 100 million, that's going to give us gross profit margin for year one, 60%. Now, if we look at year 2 and we notice that gross margin percentage jumped to 65%, that's a substantial increase. We need to ask ourselves what happened. Did sales went up and cost of goods sold stayed the same? Remember, because it's sales minus cost of goods sold. So for that to increase will give us gross margin. For that to increase, it means either sales went down, a cost of goods sold went down, or sales went up altogether happening at the same time. Well, we need to ask ourselves, how do we know this? We look at the industry. Is this something that's happening where we have more sales and the cost is going down? Well, if we know from public data that on the contrary, cost is going up, then we have to question, why did the gross margin percentage jump? That's a significant increase. What we look for? Big changes, substantial changes. For example, a 5% increase should raise a red flag, usually. But I'm not saying always 5%. It all depends on the company, on the industry, on the business. There are many factors. I'm just telling you, a 5% increase, you might say that's a huge increase or a decrease for that matter, and you need to investigate what could have caused this change. Another reason for this increase, as I told you, is an increase in sales. But we're focusing here on inventory and cost of sales. But in the revenue cycle, they would compute this figure and they will try to investigate what's happening to sales. Now, what if gross margin percentage decrease? In other words, it decreased by year 2, decreased to 55%. Well, this could be due to increase in competition. That could be the case, forcing you to lower your prices. So basically, your sales is going down, and as a result, you have to lower your prices. There's a competition. If sales goes down and your cost of goods sold stay the same, gross profit or gross margin will go down. Gross profit or gross margin the same interchangeably. Well, if that's the case, then your gross margin will go down, forcing you to lower prices. Or maybe your cost went up and you could not pass this cost to consumer. Or your sales stay the same. Your sales stay the same, but your cost of goods sold went up. Well, if that happened and you cannot pass those increased costs to customers, you'll have to absorb the prices. And this is what's happening these days, in a sense that even the president asked Walmart not to pass the tariff to the customers, because what's happening to Walmart, they buy product, a large portion of their inventory coming from China. If we put tariff on China, the cost for Walmart goes up. Now, obviously, what can Walmart do? Walmart can always pass this cost to who? To the consumer. But the president is telling them specifically, eat that increase in cost. What's gonna do to the gross profit of Walmart? Squeeze it, bring it down. So that could be another explanation. Cost of goods sold and ending inventory, remember, they have an inverse relationship. When one goes up, the other one goes down. Why are we looking for this? Because if your cost of goods sold going down, if the cost is going down, it means you have more in ending inventory. Your ending inventory is going up. There's an inverse relationship. If cost is going up, if ending inventory is lower. There's an inverse relationship between cost of goods sold and ending inventory. So you have to know this relationship very, very well. Always remember to calculate gross profit percentage when computing, when analyzing sales and cost of goods sold. So someone auditing the sales cycle would also compute this ratio, this important ratio. Let's take a look at this multiple choice question from farhatlectures.com. A substantive analytical procedure that indicates the possibility of overstatement or understatement of inventory and cost of sales would be the comparison of what? The comparison of what? Overstatement and understatement of ending inventory. Is it inventory turnover ratio with competitors? Inventory turnover ratio, very useful computation, but how useful is it when we compare it to competitors? We don't know much about the competitors, so it doesn't tell us much about ourselves. It gives us an inventory turnover is a good starting point, but not comparing it to competitors. How about current year manufacturing cost with those of the prior year? Current year manufacturing cost and comparing this with the prior year is useful, but you're only looking at manufacturing cost. Why not? Because you have finished goods, you have beginning work in process, you have raw material unused, and that's not manufacturing cost. So you're looking only at a small picture. Inventory turnover ratio, there we go. Once again, compare with the prior year. Yes, now you are looking at how fast you are turning over your inventory. In other words, you're looking at the relationship between cost of sales divided by average inventory, and you're comparing this to the prior year. Is this helpful? I would say this is helpful more than A and B. D, extended inventory value with that of the prior year. That's only gonna tell you about the inventory, but it's not gonna tell you about inventory and cost of goods sold. C is a better answer choice. What should you do now? Go to Farhat Lectures, look at additional resources, lectures, multiple choice, true, false, whatever you can find to invest in yourself, whether you are an accounting student, CPA exam candidate, or studying for any professional certification. Invest in yourself. That's the best investment you can make.